What's up, everybody? According to Redfin CEO Glenn Kelman, the housing market has hit rock bottom. Between high home prices, high mortgage rates, and depressed sales, the housing market has become completely unaffordable, at least in most parts of our country. There are some places, however, like Florida and Texas, where home prices are starting to fall due to more inventory, both from new construction being built as well as people leaving these states due to high insurance costs and high living costs. All we need is for supply to outpace demand, and we have a big shift in our housing market, which is what happened back in 2008. There is something else that is concerning that may severely impact our housing market, and that is the rise of seriously underwater mortgages across the United States. According to Adam, a leading curator of land, property, and real estate data, 1 in 37 mortgaged homes are seriously underwater across the United States, meaning the home is worth less than the remaining mortgage balance. Once again, this is what happened 15 years ago when borrowers found themselves underwater. Could this be the start of a shift in our housing market? Today, we'll take a look at an article by Elena Botros for Fortune titled, "Housing has hit rock bottom. Top real estate CEO says high home prices are shutting people out of the market," as well as an article by Andrew Dorn for News Nation titled, "Seriously Underwater Mortgages Rise Across the U.S.," as well as Redfin's latest housing market update, and we'll unpack it all. So let's dive right in. Housing has hit rock bottom, Kelman said. 4 million people are going to move this year. That is the lowest number that we've seen in many, many years. And it's just because interest rates have been so persistently high. A lot of this is due to the locked-in effect, where people don't want to sell and give up their super low mortgage interest rate and go buy something new with a much higher rate. In addition, even if they did relinquish their super low mortgage interest rate, home prices are so high right now that buying a house seems completely unaffordable. Traditionally, when rates go up, home prices go down, but that has not happened in most parts of our country. The issue is that the correction hasn't been a correction. Prices are up 5%, Kelman told CNBC, and that's because interest rates rose so fast this time, and there hasn't been a recession. So the soft landing has been good for America overall, good obviously for the economy, but it's been bad for the housing market because it's kept rates high. And so that's why there isn't more inventory reaching the market, and that's why homes haven't become more affordable. According to Redfin's latest housing market update, new listings increased 9.3% year over year, the smallest increase in 3 months. There were fewer new listings during the 4-week period ending May 5th than any comparable period on record except for 2020 and 2023. The median sale price is up 4.5% year over year, an all-time high. And the median asking price is up 6.5% year over year, also an all-time high. There is some good news. We did have a dip in mortgage rates last week, which did give prospective buyers some relief. According to Mortgage News Daily, the daily average 30-year fixed mortgage rate was 7.2% on May 8th, down from a 5-month high of 7.52% 2 weeks earlier and up from 6.5% from a year ago. This was a result of encouraging economic news as well as last week's soft landing jobs report. Where mortgage rates are headed really depends on economic conditions, particularly inflation, which is proving to be stickier than expected. And inflation has been so stubborn, for one, because of housing. It's a large component of the consumer price index. We've seen the housing component soften a bit, but not enough to bring rates down, Kelman explained. That being said, Kelman believes that today's market could be better than last year's, when existing home sales fell to their lowest point in 30 years. He said that people are less likely to put off their home buying plans this year just because they're going crazy living with their ex-wife, these are his words, or they have a third baby and there's no space in the house. But still, the overall economic conditions for buying a house are rough. Botros reports that in a separate interview with CNBC, Realtor.com's chief economist Danielle Hale said there are 36% fewer homes for sale now than before the pandemic. And with high home prices and high mortgage rates, buyers need to earn more than $100,000 in 34 out of the 50 largest metropolitan areas to buy a typical home. With the housing market being so unaffordable, it's really no surprise that there's a rise in underwater mortgages. An underwater mortgage is the result of people overpaying for their home or putting too small a down payment on the property. So if the value of the home declines, the mortgage can become easily underwater, meaning the home is worth less than the remaining mortgage balance. A seriously underwater mortgage refers to a loan that is 25% or more than its market value. During the 2008 housing market crash, many homeowners simply stopped making payments on their underwater properties. Although the latest 2024 U.S. Home Equity and Underwater Report from ADAM shows that the portion of mortgaged homes that were seriously underwater in the United States rose in the first few months of 2024 from 2.6% to 2.7% nationally, this share still remains well below the pre-pandemic level when 1 in 15 homes, or 6.6%, fell into that category. The states with the biggest increases in seriously underwater mortgages were in the South, which already had some of the nation's highest levels of seriously underwater mortgages. The largest quarterly increases were in Kentucky, where seriously underwater mortgages went from 6.3% in the last quarter of 2023 to 8.3% in the first quarter of 2024. West Virginia up from 4.4% to 5.4%. Oklahoma up from 5.5% to 6.1%. Arkansas up from 5.2% to 5.7%. And Delaware up from 2.3% to 2.7%. The metros with the most seriously underwater mortgages are Baton Rouge, Louisiana, which tops the list at 13.4%, followed by New Orleans, 7.3%, Jackson, Mississippi, 6.5%, Little Rock, Arkansas, 6%, and Syracuse, New York, 5.6%. Even despite the rise in underwater mortgages, housing equity remains solid on a whole. Homeowner balance sheets continue to benefit in a huge way from the boom times in the form of elevated equity that can be used to help finance all kinds of things, from home renovations to business startups. Still, the windfalls are starting to erode bit by bit amid mounting signs the market is no longer so superheated, said ADAM CEO Rob Barber. Too early to make any broad statements about the market direction, especially coming off the typically slower fall and winter months. But amid the recent trends, this year's spring buying season will be of heightened importance in telling us if there is a new long-term market pattern developing. Between the rise in seriously underwater mortgages and the softening of home prices in certain states like Florida and Texas, there are definitely signs that the housing market is shifting. I can tell you that where I am in the DC area, things are definitely starting to feel a little different. Back in the first quarter, it seemed like every good house that hit the market was selling in multiple offers and escalating way above the asking price. And by good houses, I mean those that show well and are priced right. Now it seems like those homes are the exceptions, not the rule. We still don't have a lot of inventory and home prices are still really high, but the craziness seems to be gone, at least this week, which is unusual because right now we're in the height of our spring markets. Other metrics that show that the housing market is softening are reflected in Redfin's latest housing market update for the 4 weeks ending May 5th. 44.9% of the homes sold in the first 2 weeks, down from 47% a year ago. The median days on the market is 34 days, up 1 day from a year ago. 30.4% of the homes sold above the list price, down from 32% a year ago. And 6.2% of the homes did have a price drop, up 1.9 points from a year ago. These are national numbers and they aren't drastically different from last year, but the trend is obvious. If you missed last week's video on a possible solution to our failed housing market, definitely check that out next. Thanks for watching. I do appreciate it. Bye!